Welcome to My Talk, the podcast series brought to you by ISS Market Intelligence. And thank you for tuning in. The focus of our discussions on My Talk is the global retail financial services marketplace and its many subsectors: asset management, wealth management, life insurance, banking, and so on. For more than 3 decades, the ISS Market Intelligence team and its previous companies has been a passionate student of this business. Our specialty here is to explore the proverbial second day story and really peek under the industry headlines and try to understand the bigger meaning or discern the bigger meaning of certain trends and developments in the industry. We do so with the help of industry experts and thought leaders. We do create new episodes monthly and sometimes even. So if you enjoyed this episode of My Talk, please remember to subscribe to our podcast on your preferred podcast platform. My name is Goshka Folda. I'm your host and the global head of research at ISS Market Intelligence. So we're in January. Can you believe it is already 2024 and it is a leap year, no less. So we get one extra day to prepare great research and have more discussions about the business, which we of course love. And let us leap into this year with a hot topic of the household wealth and the fund industry flows. Lots of debate about the topic of the household wealth and the fund industry flows. Lots of debate about cash on the sidelines and what's going on, where is the money going. Very hot topic really around the world in the asset management business. In North America, it's particularly hot. We hear this from our US clients and Canadian clients all the time. So it's quite as with our Canadian data and kind of contemplate where the Canadian households are in terms of their financial standing and what is in store for the deposit and fund businesses this RRSP season. For those of you joining us from outside of Canada, the first 60 days of the year are an important period for making investment and savings decisions because they coincide with the tax deadlines and special credits that we do get if we invest in our retirement plan. So that's why we thought it would be a good idea to start with Canada. And this is also where we have kind of a really broad base of really excellent data that we can delve into. And to help me think through this topic is our own data and methodology and forecasting guru. I am delighted to be joined by Senior Research Associate at ISS Market Intelligence, Will Stevenson. Will is a repeat guest on this podcast, so I have probably already waxed poetic about his tremendous capabilities. But I did want to mention that a lot of the work that Will is going to talk about stems out of our household balance sheet report research. And as you might know, those of you who are familiar with that property, this was our first report when we started the business, published in '93, and of course, the most recent edition was published exactly 30 years later in 2023, towards the end of the year. So Will was or is the chief architect of this most recent edition of the Household Balance Sheet Report. There's no mean feat for someone as young as Will, because not only did Will lead the forecasting process for kind of thinking about the business 5 to 10 years hence, along with Carlos Cardone, but Will also took it upon himself to manage a team of researchers on 3 continents to create and deliver a compelling, wise, and thoughtful outlook for the future of Canada's household wealth in the decade ahead. And you do know, or if you don't know, let me tell you this: having run a research team for now a long while, herding researchers and managing research teams, it's like herding the proverbial cat. So, and herding me, no less, is quite a different story. And Will did it really great. Well done, Will, and welcome to the podcast. where the Canadian households are right now. In the household balance sheet report, when you and I discuss kind of the main themes, one of the big ideas that you spoke about is this kind of big squeeze, which is evident. The financial squeeze on the Canadian households is both evident in the short term, but also possibly the financial squeeze on the Canadian households is both evident in the short term, but also possibly might have some kind of lasting effect on Canadian household finances in the longer term. So now that we are into 2024, the net savings of Canadian households appear to be. This begs the question: where will the fund industry or the asset managers find flows into their products?
Yeah, thanks, Goshka. So it just after a couple of years, so 2021 and 2022, where flows into financial assets were around 300 billion, 200 billion. The headline savings rate from Statistics Canada, as well as from some other publications, was jumping into double digits early on in 2020 and 2021. And a lot of that money found its way onto asset management product shelves in 2021 and 2. 2022 less so, especially near to the end of the year. That's largely done. As much as there is money on the sidelines in GICs and some of these money market mutual funds, ETFs, that could find its way into market exposure. One of the sort of prevailing myths or consistent myths over the past couple of years is that there's a lot of money sitting in checking accounts, sitting in savings accounts from the retail investor, just waiting to find its way onto the shelf. That's largely not true. We have a lot of data on those accounts for Canadians are largely where they were in 2019. So those kinds of products driving flows is certainly not going to happen. And with the savings rate trending towards zero, new money, new savings isn't going to make its way onto asset management shelves either. So where does that leave asset managers or funding flows? They're really going to have to pull it from somewhere else. There are some good news about 100 billion in GICs, so that's across both retail on the in the branches and banks, direct banks, those e-bank GICs, which popped a little bit in 2023. As well as those on advisor shelves, about 100 billion, about 100 billion combined is set to expire in the first quarter of this year. So where does that leave asset managers? They're going to have to compete against that. The yields on those have come down below that magical 5% band that was driving a lot of consumers or savers into those GIC products. But when an asset manager is putting a product in front of a client, they're going to have to at least say they're going to do better than that. It's a little bit easier with rates on those coming down and fixed income rates remaining stubbornly high for some of those products, especially on the high yield side. But it's really about doing better than what a GIC can promise someone. All of that money is going to have to come from those products.
Yeah, well, that's such a great point. And actually, we're looking at this same topic in the US, and I know I'll be circling back to you for your, that magic number that you and I talked about, going way back into the 90s, the 7% as you close in on any term deposit with 7%. I don't want to say it's game over, but it is a tough slog. And I think what you're saying is that asset managers, product developers have to really make the case for those maturing assets to really come on board. Is not kind of an easy winning situation like we saw when there was explosion in savings, as you pointed out, in the 300 billion. There's also some differentiation between the demographic cohorts of investors and clients that will have impact on kind of where the flows can be found, and can they be found?
Yeah, for sure. So of that 100 billion that's set to rebook, I'll put another number in front. That 300 billion, which is kind of net change in GICs over the course of the past couple of years, that 300 billion has been added to GICs. So who's added that is the main question. If it's baby boomers, 55 to 75, that age category is prime user has been and still is. And a lot of that money, a little over a third of that money, based on what we're seeing, was done by that cohort as well. So the recent retiree or soon to be retiree added a lot of that money. Now that was good news for those client segments because they were saving so much throughout that was good news for those client segments because they were saving so much throughout the pandemic. But those clients are also much less likely to abandon a GIC. Many of them are using them for monthly income. They could be pulled by a monthly income fund if that promises some price appreciation along with a significant yield. But a lot of them are looking at safety, inflation, eating into their earnings, and that's where the price appreciation can be a benefit for them. But those were recent retirees who saw their money go up, thought this is my time to retire. They don't want to necessarily go back to work, but they are seeing inflation eating into some of their earning power. So they're concerned about the safety of this retirement plan and will tend to go towards safety over and above. Another third is what I would call kind of the still in accumulation but soon to be done Generation X. They picked up likely over a third as well of that 300 billion, and that was largely advisor driven. You saw a lot of that on advisor shelves saying, this is 5.5–6%, what it was at the time for a year. This is a real return GIC, which was not the case for many years. Plug a bunch of your savings into this for the short term and revisit in the future. Now, a lot of that may find its way into accumulation products, but this generation is also the most exposed to debt. So any sort of debt strain, debt consolidation, this generation isn't going to be putting new savings into the system because they're going to be constrained by that. But also some of them may be looking at consolidating some of those, you mentioned earlier, in the long term. So that kind of money finding its way long term onto asset management shelves is not as guaranteed as, say, some of the high net worth baby boomers who are looking for monthly income, not as exposed to debt, could easily recycle this into other products. At the bottom end, I would say millennials and Gen Z, and this is based on basic age data that we get from some of our banks and some of our tax filer data that we get. This was opportunistic. Many of them very short-term GICs on digital banks in many cases. A lot of those digital banks added a lot of GICs from primarily this client. Very short-term GICs on digital banks in many cases. A lot of those digital banks added a lot of GICs from primarily this client segment. This is kind of the most eligible to move, and the most eligible to move into kind of riskier accumulation products. Particularly Generation Z, very low debts. The lucky ones did, the ones who didn't just stick all their money into individual tech stocks like we saw in sort of 2021, 2022. But many of them are going to be looking for accumulation and also looking for accumulation product in particular. So those who got the GICs, they're going to look for a stronger accumulation product for the long term. Those that were looking into riskier assets through the course of 2021, 2022 may not have done well over the past couple of years. So some of them looking for accumulation through advice, accumulation with a product. That's going to be a key client segment for advisors as well as for asset managers to target.
Important to segment your potential targets in terms of, both for financial institutions, branches, and for advisors, and to understand the dynamics. And clearly, as you pointed out, each cohort has a different set of parameters that they're looking at, and from kind of the older has a different set of parameters that they're looking at, and from kind of the older ones, safety and protection. But I think that also it's a bit of a challenge for the younger generations, the Gen Z and millennials, because especially Gen Z, because some of those early experiences with accumulation ideal. And I know you talk about that quite a lot in the household balance sheet report.
Yeah, so the first dip into investing for many investors is very important and can in fact set the stage for the rest of their investing life. There's really two influences that would do that really press on younger investors. The first is their first experiences. So if it's a down, it can be a down for a very long time. They can stay in safety. The other is their parents' experience. So in Canada, that pushes a lot of young people towards real estate, but only so much as they can afford it. Many of these younger investors are still priced out for the time being from the real estate market, but they are looking to accumulate to that point. And this is going to be very important for advisors as well, given the recent launch of the First Home Savings Account, which is not, we do know it's not available for every advisor. It's not available on every dealer yet. It's still working its way through the system quite slowly after being launched in April of last year. That's going to be key for advisor engagement of these younger clients. A lot of these younger clients are going to be looking to save and invest for the purpose of real estate primarily, over and above investing for, say, retirement, because they have one goal first and the second goal second. And one of my parents had a poor uh, first experience with real estate in sort of the 91 era. The other one didn't. And so one of them really pushed for real estate. And the other one did not early on in their investing life. And they eventually went with real estate, and that has been the right decision, but you never decision in the future.
Yes, such great points. And having arrived in Canada around 1990, 91, I guess I was a bit scarred by the whole situation with real estate. So that was not an option that I considered really powerfully at the time, because of the was not an option that I considered really powerfully at the time, because of the conditions and market conditions, as you pointed out for one of your parents. So listen, let's wrap up with your fund sales predictions for the first quarter. A little bit about what you think, what this means for, so we well know, fund sponsors, fund manufacturers can fight a lot of things, but very difficult to fight the trend of asset class directionality in the marketplace. And any thoughts if there could be any surprising developments in the marketplace that would maybe result in a slightly different outlook. Tell us, what do you think?
So for the short term, and I'll just talk about 2023 for a second, which 2023 was a down year for investment funds in general, but it was really active mutual funds, a lot of that into annuities. But in in the end of it, it was recycling towards yield. It was a positive year for ETFs, however, a lot of it again in the yield ETFs. So that uh, given investors are chasing the high yields of 2023, we expect that to largely continue. So in terms of chasing the high yields of 2023, we expect that to largely continue. So in terms of surprise events, one of them was one potential one was this morning, which didn't end up happening, which was the inflation release in Canada. I'll play towards investors' home biases here for a second and say that, a 3.4% print this morning, that gives the central bank a lot more leeway to lead interest rates higher. So that pushes more and more money towards some of these higher yielding income products. So on the mutual fund side, with some of those GICs expiring, we expect it to be a similar net mutual fund season as it was last year. So netting toward zero, a little bit above zero, with that money coming primarily from GICs. With that money coming primarily from GICs and GICs from baby boomers who are recent retirees, a lot of them are going to be looking towards that monthly income. And so those monthly income products with distributions that go out every month and we think are going to be very very well sold. In addition, any kind of high yield product, the soft landing kind of narrative is still very present. So when that is present, looking for spread in high yield products is going to be easier to sell than in kind of a hard landing scenario. However, some investors might be getting a little bit nervous with these rates staying as high as they are, that the landing may not be as soft as they thought. On the ETF side, one of the things that I talked about earlier on the kind of millennials, Generation Z, earlier investor experience, ETFs in 2023 were really towards the fixed income. I expect a little bit more into kind of real accumulation equity side, and particularly active equity side. A lot of these younger investors, they love the word alternative. They love, private, anything like that. Whether it's really active, private equity, private credit, that's active equity and active credits. It's within a particular structure, but that's active. And a lot of those active ETFs have been launched over the past year. So for younger investors, if they're looking for picking or tactical allocations, because that's where they're coming from is doing their own tactical, because that's where they're coming from is doing their own tactical allocations. An active ETF, even if it's pure equity, is looking to be a good sale in the first quarter of this year. I will say just from the midterm on the interest rate side, when we did the household balance sheet, we didn't predict any interest rate cuts before 2025. In the first period, we kept it for higher for longer than what was being called. It's looking to push towards that direction in 2025. However, that the 125 basis points of expected cuts that some were predicting to start here, if you look back in 2023, that's starting in kind of Q4, Q1 of 2025. That leaves a lot more time for these kinds of yield products to be picked up by clients. It also starts to push into a lot more mortgage renewals, which pushes this net savings towards zero a lot longer, or does reduce the overall level of fund sales into the mid and long term the further this gets pushed ahead. However, for those that are not debt constrained, that kind of the older and the very younger, that's where we expect a lot of those fund sales to come from.
Yeah, and then a great landing. You've landed a good punch on our expectation of interest rate cuts, because I think we were a bit lone wolfish on that one. Everybody was predicting a much quicker dial down, and I think we were arguing that it's going to take some good time. And I think that's going to land, Will, I think a good call on that. And I would say it's all you. I'll claim the fame, but it's all thanks to you and the thoughtful modeling that you do. This is great stuff, Will. Thank you very much. You have given us a lot to think about. I think it's going to be, navigating these financially tougher conditions is a challenge for Canadian households, but also really it translates into some challenges, but possibly also opportunities for asset managers and for the large and well-populated business. I think we'll see who will be able to translate those conditions into tailwinds for their business, and who will be challenged. Your point about active ETFs and yield, this is and alternatives also, focusing a lot on private credit and yield products. Clearly, I think you are spot on with that. And the active ETFs, which just published a big report in the US, and really the flows have been accelerating. Again, we were early on in predicting that, then it took a few years, but I think we're getting there. So thank you very, very much, Will. This was great stuff. And that is a wrap for us in January. I encourage our listeners to come back to join us in the coming months, as we have a number of quite exciting episodes on the burner stove, if you will. We have a very special guest, a major leader of a distribution organization in the at an asset manager in the US, and a guest host, our own Ashley Wood from our US team. And we will really delve deeper into what it takes to succeed in today's sales game. Building on Will's point about that kind of standoff, if you will, between term deposits, and the accumulation or wealth and investment strategies, and we'll figure it out how that is playing out in the world's largest asset management market, which is the US. As always, I encourage everyone to ping us with your ideas about specific topics that you might want for us to tackle in the future. And on behalf of ISS Market Intelligence, let me thank you for listening to this episode. And of course, I would like to wish you a wonderful 2024. And let's leap into the future. With that, I'm signing off. Thank you.